If you're using a credit card right now, whether it's for groceries, gas, or that weekend getaway, there's a good chance it's quietly draining your bank account. Most people in the US and Canada don't realize it, but a few small mistakes with their cards can add up to thousands of dollars in wasted money every single year. And it's not just people who are in debt, even folks who pay their bills on time can still fall into these traps. In this video, I'm going to walk you through 5 of the most common credit card mistakes that cost North Americans the most money, and more importantly, how you can stop making them today. Stick with me, because even changing one of these habits could save you hundreds or even thousands of dollars. If you're swiping your credit card for groceries, gas, coffee, or that last-minute weekend trip, you're not alone. In the United States and Canada, almost everyone uses at least one credit card every single day. They're convenient, they build credit, and they even give rewards. But here's the uncomfortable truth: those little plastic cards are also one of the easiest ways to leak money without even noticing. A few small habits, repeated month after month, can quietly drain hundreds or even thousands of dollars from your pocket. What's wild is that most people think they're doing everything right. They pay when the bill arrives, they use their cards for points, they try to keep up with payments. But the system is designed to profit from small mistakes. Even people who believe they're responsible can get caught in traps set by interest rates, fees, and billing cycles. And that's exactly why I'm making this video. Today, I'm going to walk you through 5 of the biggest credit card mistakes that cost people in the US and Canada serious money, and more importantly, how you can stop making them right now. Fixing just one of these habits could mean an extra vacation, a paid-off car loan, or more money for your emergency fund instead of the bank's bottom line. Let's jump into the first mistake, because it's the one that trips up the most people. Mistake number 1: paying only the minimum balance on your credit card. On the surface, it looks harmless. The statement says minimum due $75 or maybe $120, and you think, great, I've handled it. But what that minimum really does is keep you in debt for as long as possible. Right now, the average credit card interest rate in the US is over 20%. In Canada, it's not much better. So if you're carrying, say, a $2,000 balance and just paying the minimum, you could be handing your bank hundreds or even thousands of dollars in interest over time and still owe money months or years later. Credit card companies designed that minimum payment to look easy, but it's actually a treadmill. You're moving, but you're not getting anywhere. The longer you stay on it, the more profit they make. The smarter move? Always try to pay more than the minimum, ideally the full balance every month. Even adding an extra $50 or $100 above the minimum can slash the time it takes to get debt-free and save you a small fortune in interest. Before you hit pay on your next statement, ask yourself, am I paying off my balance, or am I paying off my lender's profits? Changing this one habit alone can keep thousands of your hard-earned dollars in your own pocket instead of theirs. Alright, now that we've talked about the danger of paying only the minimum balance, let's move on to the second mistake, and honestly, this one is sneakier because it hides behind flashy marketing. Mistake number 2: ignoring annual fees and picking a rewards card that doesn't actually match your spending habits. In both the United States and Canada, credit card companies compete fiercely for your attention. You've seen the commercials: shiny metal cards, celebrity endorsements, promises of thousands of points, free travel, cash back. It all sounds like free money. But here's what doesn't make the commercial: the annual fee and the fine print. Many of those premium cards charge $95, $150, even $550 every single year just for the privilege of carrying them. And if the rewards you're earning don't outweigh that fee, you're essentially paying a yearly tax to the bank for nothing. Let me give you a quick example. Say you sign up for a travel rewards card with a $95 annual fee because you love the idea of free flights. But you only fly once a year to visit family, and most of your spending is on groceries and gas. If that card only gives 1 point per dollar on everyday purchases, you might earn the equivalent of maybe $60 in rewards over the whole year. You've now paid $95 to earn $60. That's a $35 loss before you even factor in interest or other charges. Multiply that by several cards or several years, and you've quietly handed over hundreds or even thousands of dollars for perks you didn't really use. The flip side is just as common. People sign up for no-fee cards with tiny rewards because they're afraid of fees, but they spend heavily in categories like travel or dining where a slightly higher-end card could have saved or earned them much more. In other words, the card doesn't fit the lifestyle. The bank still wins. The smarter move is to take a hard look at how you actually spend money. Pull up your last 3 months of statements. How much went to groceries, gas, restaurants, travel, online shopping? Then match a card to that spending pattern. If you travel constantly for work, a travel rewards card with an annual fee might be worth it because you're earning far more than you pay. If you mostly spend at supermarkets, a no-fee card with high grocery cash back might be better. The point is to run the numbers on your own situation, not just grab whatever card is advertised on TV or social media. Also remember that rewards points are not free money. They can be devalued, they sometimes expire, and they can tempt you to overspend just to earn points. If you're buying extra items or choosing more expensive flights just to chase rewards, you're already losing. The bank has won again. So here's a simple rule of thumb. Every January or whenever your annual fee hits, ask yourself 2 questions. 1. Did the rewards or perks I actually used last year exceed the annual fee I paid? 2. Does this card still match the way I spend today? If the answer to either question is no, consider switching to a different card or downgrading to a no-fee version. Many issuers will let you switch without a hard credit check. That one phone call can save you hundreds. In the US and Canada right now, households are carrying record levels of credit card debt, and banks are making record profits from interest and fees. You can't always avoid using a credit card, but you can absolutely stop paying for perks you don't use. It's your money, and you should keep as much of it as possible. To recap mistake number 2, don't ignore the annual fee, and don't assume every rewards card is automatically a good deal. Choose a card that truly matches your spending and reevaluate it regularly. By making this one shift, you could save hundreds of dollars a year without changing a single thing about how you shop. That's real, tangible money back in your pocket instead of your bank's balance sheet. And that's exactly what we're here for, to help you keep more of what you earn. And that one change alone can save you hundreds of dollars a year without changing a single thing about how you shop. That's real, tangible money back in your pocket instead of your bank's balance sheet. Now, let's roll right into the 3rd mistake. Because this one can quietly damage your finances even more than annual fees. It can actually raise the cost of every future loan you take. Mistake number 3, making late payments and hurting your credit score. In the US and Canada, your credit score isn't just a number on a screen. It's a reputation score that lenders, landlords, insurance companies, and sometimes even employers use to decide how trustworthy you are with money. One missed payment on a credit card can sit on your credit report for up to 7 years. And the penalty isn't just the $30 or $40 late fee on your statement. The real cost is the higher interest rates you'll pay on future credit cards, car loans, and mortgages because your score dropped. Over time, that can mean thousands of dollars in extra interest. Think about it, a 30-day late payment on a $100 bill could eventually cost you tens of thousands in higher mortgage rates. That's how powerful your payment history is. Yet many people slip because of simple things. A bill got buried in their email, a paycheck hit a day late, or they assumed the minimum was automatically paid. Credit card companies know this, which is why due dates sometimes shift slightly from month to month. It's not always obvious, and it catches people off guard. The good news is you can protect yourself with a few small habits. First, set up automatic payments for at least the minimum due every month. That way you're never late even if you're traveling, sick, or busy. Second, put calendar reminders on your phone a few days before the due date to pay the full balance. Third, if you know a payment is going to be late, maybe because of a banking error or a lost job, call your issuer before the due date. Many banks will waive a late fee if it's your first time or if you've been a long-time customer. Acting before the payment is officially late can save you the ding to your credit score. Another overlooked tip, check your statements and your credit report regularly. In both the US and Canada, you're entitled to free credit reports from the major bureaus. Reviewing them a few times a year can alert you to missed payments you didn't even realize were reported or to errors that could be dragging your score down. Disputing a mistake early can keep your score healthy and your borrowing costs low. Why does this matter so much? Because a strong credit score is like an invisible discount card for your financial life. With a high score, you can qualify for lower interest rates on mortgages, car loans, and even credit cards themselves. With a weak score caused by late payments, you'll pay more for the exact same products. Over decades, that's tens of thousands of dollars in lost wealth. To recap mistake number 3, never let a payment slip past the due date. Use autopay, set reminders, and stay on top of your credit report. Protecting your score isn't just about pride, it's about keeping your future borrowing costs as low as possible and keeping your hard-earned money in your own pocket instead of handing it over in interest and fees. In a moment, we'll move on to mistake number 4, but if you've been following along so far, you can already see a pattern. Credit cards aren't evil by themselves. They're tools. But the small traps, minimum payments, mismatched rewards, late payments are where banks make their money. Avoiding those traps is how you keep more of yours. Let's roll straight into the 4th mistake, because this one quietly hurts people who think they're being responsible. Mistake number 4, maxing out your credit cards or keeping your balances too high even if you pay them off later. Most people in the US and Canada have heard about a credit limit, but very few realize how much of that limit you actually use matters almost as much as whether you pay on time. This is called your credit utilization ratio, basically the percentage of your available credit that you're using at any given time. The credit scoring models used in the US and Canada see high utilization as risky behavior. If your limit is $5,000 and your balance is $4,000, you're using 80% of your credit. Even if you pay the bill in full at the end of the month, that high number could already be reported to the bureaus and drag down your score. Why does that matter? Because a lower score means higher interest rates, smaller credit limits, and sometimes outright denials for loans or apartments. It also means your existing credit cards can hike your interest rate because you suddenly look riskier on paper. In other words, maxing out your cards is like signaling to lenders that you're in trouble even if you're not. Here's a quick real-world example. Say you have 2 cards, each with a $3,000 limit. If you run one card up to $2,900 for a big purchase and keep the other at 0, your utilization on that first card is 97%, and your total utilization is about 48%. That could easily shave 30 to 50 points off your score temporarily. That one dip could cost you thousands if you're applying for a car loan or mortgage while your score is down. The smarter move? Try to keep your balances below 30% of your limit, ideally under 10%. Spread purchases across multiple cards if you need to. If you're about to make a large purchase that you'll pay off quickly, consider paying it down before the statement closes so the lower balance is what gets reported. And if you have a solid history, ask for a credit limit increase that raises your available credit and lowers your utilization without you spending a dime more. Also, be careful about closing old cards. People sometimes close a paid-off card to simplify their wallet, but doing so can shrink your total available credit and spike your utilization percentage on the cards you keep. That can hurt your score even if you're not carrying new debt. Think of credit utilization as a snapshot lenders take every month. Even if you're a full balance payer, the snapshot can make you look maxed out. By keeping your balances low, paying before the statement date, and maintaining healthy limits, you present a picture of stability. That picture translates into better rates, higher limits, and more money left in your pocket instead of lost to interest and fees. So to recap mistake number 4, don't max out your cards. Don't let your utilization run high, and be mindful of how closing or opening cards affects your overall available credit. Managing that ratio is one of the quickest ways to boost your score and protect your wallet. In a moment, we'll move into the 5th and final mistake. And it's a fun one because it's about all the perks and protections most people leave on the table. And be mindful of how closing or opening cards affects your overall available credit. Managing that ratio is one of the quickest ways to boost your score and protect your wallet. Now let's get into the 5th and final mistake, and unlike the others, this one isn't about avoiding pain, it's about missing out on free value. Mistake number 5, not using the perks and protections your credit card already gives you. Credit cards in the US and Canada aren't just pieces of plastic. They're bundled with a surprising amount of benefits that most cardholders either don't know about or never bother to use. These perks cost you nothing extra, you're already paying for them through your annual fee or through the interchange fees merchants pay. Leaving them unused is like leaving free money sitting on the table. For example, a lot of mainstream cards offer built-in cashback or statement credits. If you're using a 1.5% cashback card for every purchase but never redeem the rewards, that's literally dollars left unclaimed. Travel cards often include trip cancellation insurance, lost luggage coverage, or even rental car collision damage waivers. Many Visa and MasterCard products in the US and Canada also come with Purchase protection or extended warranty. Coverage on electronics and appliances, meaning if your new phone breaks after the manufacturer warranty expires, your card might reimburse you or cover the repair. Another big one is price protection. Some cards will refund you the difference if the item you bought drops in price within a certain period. That's money most people never think to claim. And don't forget about perks like free credit score monitoring, no foreign transaction fees, airport lounge access, or cell phone protection when you pay your bill with the card. All of those benefits can easily add up to hundreds of dollars a year. The problem is that card issuers don't exactly shout these benefits from the rooftops. They're buried in your cardholder agreement or hidden on a web page. So the smartest move you can make right now is to spend 10 minutes on your bank's website or call the number on the back of your card and ask for a full list of benefits. Make a note of the ones you're likely to use. Even if you only take advantage of one or two perks, you've already gotten more value out of your card than most people ever do. Another tip, set a calendar reminder to review your card perks every year. Benefits change. Some get added, some disappear. Staying aware means you won't miss new opportunities. And if you're not using the perks at all, that's a sign you may be paying for a card that doesn't suit you and it's time to downgrade or switch. So to recap, mistake number 5, don't ignore the benefits you're already paying for. Learn what they are, use them strategically, and let them work for you instead of the bank. Over time, this habit can put real money back in your wallet, offset annual fees, and even protect you from unexpected costs. And there you have it, 5 of the most common credit card mistakes costing people in the US and Canada thousands of dollars. And the simple steps you can take to avoid them. Fixing even one of these habits can improve your credit score, lower your interest payments, and give you back control of your finances. If you found this helpful, take a look at your own cards tonight, see which mistakes you might be making, and start saving yourself money immediately. So let's wrap this up. We've covered 5 of the biggest credit card mistakes that quietly drain money from people across the US and Canada, paying only the minimum, choosing cards with the wrong fees and rewards, letting a payment slip and hurting your credit score, running up high balances that damage your utilization ratio, and ignoring the free perks and protections built into your card. Fixing even one of these habits can save you hundreds, sometimes thousands of dollars a year. Fixing all 5. That's like giving yourself a pay raise without working a single extra hour. You'll pay less in interest, keep more of your hard-earned cash, and build a stronger credit score that opens doors to cheaper loans, better apartments, and lower insurance premiums. Now it's your turn. After this video, grab your latest statement or open your Cards app and do a quick audit. Are you paying off your balance? Are you getting enough value to justify your annual fee? Are you using the perks you're already entitled to? 10 minutes of checking could uncover a ton of hidden savings, and if you want more straightforward, no fluff tips like this that actually help North Americans keep more of their money, make sure you hit the like button and subscribe. I post new videos every week on how to outsmart banks, credit card companies, and other money traps so you can build the life you want. Don't miss out on the next one. Your wallet will thank you.